Hello, everybody. Welcome, everybody. My name is Gunnar Lovelace. I'm really excited to open this conversation about the kind of historical importance and urgency of making money doing good. I'm going to share a little bit first and then welcome up some of my panelists. In an era of hyper-concentration of wealth and the very social fabric of Western democracies unraveling, as we reach record highs in the stock market, every major ecosystem on the planet is either collapsing or on the verge of collapse. Over the last 50 years, over 80% of all animal wildlife ecologies have been decimated in the rainforests. And in spite of capitalism being wildly successful in the 20th century, one of the critical flaws is that it does not accurately price the true costs of the products that we buy. This is the concept of negative externalities. When I buy a hamburger, it does not reflect the price of the destruction of the topsoil, the poisoning of the rivers, or the decimation of the rainforests. And often companies benefit from massive tax subsidies that we as taxpayers fund, where these companies profit on the destruction of these supply chains and of the planet, with the IMF reporting that over $5 trillion a year are in fossil fuel subsidies alone. And so making money doing good is critically important for us to reimagine what capitalism is, the urgency of this moment. As an early investor in Beyond Meat, I've seen the billions of dollars flooding into the vegan product development space to capitalize on the consumer revolution. As someone who grew up poor with a single mom, I was fortunate to have a full-ride scholarship to a school where I grew up with the children of the Patagonia family, the Chenards, and I got to see how they built positive externalities into the architecture of their business. Things like taking recycled plastic bottles and turning them into jackets for the first time in history, and the way that those types of investments built deep customer loyalty, and the way that customer loyalty has protected and defended their brand from many players that have repeatedly tried and failed to encroach on their turf. There are 1,000 places you can buy fleece jackets, and yet Patagonia's business booms because they provide a great product and service, and they connect people to a higher purpose. This has been a North Star for me in my work, starting and selling 2 software companies, and then very active as an investor and operator in dozens of high-growth conscious consumer brands around these issues. My last company is a company called Thrive Market. We sell organic groceries at wholesale prices, direct to consumer to the US audience in eco-friendly packaging. We're the first direct to consumer brand to go zero waste from distribution center to landfill. And when we started that business, all of the top 60 West Coast VC firms rejected us. They said, how are you going to compete in a hyper-competitive market? You know, there's dozens of players with $1 billion of sales each annually, and then there's Amazon. And over the last 5 years, we've been blessed with incredible support, millions of Americans, 700 employees, over $200 million of capital raised. And one of the key things that we did there was we were the first direct-to-consumer business to arbitrage our equity across a broad network of hundreds of bloggers. And it was a very simple, powerful model to compete in this massive market. We pay the blogger $50 of equity for every customer that they bring us. And investors would hear that initially and say, that sounds really negative and inflationary, you're diluting the cap table. But in fact, it's massively accretive because we get $1,500 of market cap appreciation from the capital markets for every customer that we paid $50 in equity. It's a 30x arb trade. And that model was so successful that many quarters over the last 5 years, we've had to tell our partners to stop promoting because every 300,000 users per month that we bring in, we have to scale thousands of linear supply chains. And as a result of that model of distributed ownership working so well, we set up an investment ecosystem where we've been able to do that for over a dozen conscious consumer brands, all of which are booming, the first of which we sold for over $230 million in less than 3 years. Same model, just arbitraging the equity through distributed ownership. And so as a student of capitalism, I've spent a lot of time thinking about the corruption of the financial system and how it's important that we empower people to transform their relationship with money, to take responsibility for the decisions that we're part of every day, all day long. And I knew that I could drive 10 million Americans to a platform like Good Money, which is my new company launching in March, using the same kind of model with the bloggers that we had made so much money with and made so much money for. But why wouldn't we also make customers owners? Why wouldn't we give them the ability to participate in the upside? Why wouldn't we unlock the same kind of rabid engagement dynamics that we had seen from bloggers at even greater scale to consumers? And as we created some simple economic game theory models around this, a very simple realization occurred, which is that if you look at any major consumer brand in capitalism today, the value of that brand comes from people buying from it. So why shouldn't consumers expect to own the businesses they buy from just for being a consumer? Capitalism literally hasn't evolved this way. We thought the world was flat until we didn't. Capitalism has evolved the way it has until we change it, and that Good Money is amongst a first wave of companies in history that realign those incentives in a powerful way that uses distributed ownership and empowers consumers to expect to own the businesses they buy from. And so we stand on a razor's edge, and the stakes could not be higher. We are the Noah's Ark generation. We are the ones that will determine who lives and who dies in the 21st century. And in the next 30 years, our children will look back at us, the people in this room, the friends that we know, the companies we built and invested in, and they will say that we were the ones that built the bridges that created a thriving future for humanity and the planet. Or they will say, what the fuck were we thinking? How could we have been so blind to delude ourselves to think some version of the status quo would continue indefinitely as we scream off the cliff? And I believe in the incredible power of humanity to rise to the challenges. And so it is with a great honor and privilege that I welcome up my panel guests, wherever they are. Okay, great. And we're going to have a lively continuation of this conversation. Thank you so much.
Good afternoon. I'm Jennifer Schenker, editor-in-chief of the Innovator. We're a global publication about digital transformation, and I'm the moderator of this panel. And Gunnar, thank you so much for helping frame this conversation so well. Before we get into a broader, deeper discussion of using money for good and distributed ownership, I'd like to turn to Nina and have her tell us a little bit about her approach of using money for good.
Yeah, I'm Nina. I'm part of a German fintech called VisualVest. We're based in Frankfurt, and we combine technology and wealth management. So we are a so-called robo-advisor, offering investment solutions for individuals. So everybody knows right now, if you put your money in a savings account, you don't get any returns. You even lose money because of inflation. And young people want to invest their money online. They don't want to go to a bank anymore. And we build a solution for them so they can invest their money in funds, in a portfolio of different funds. And completely digital. And what we did, this is why I'm here, we were the first robo-advisor in the world offering sustainable solutions. So individuals can invest in portfolios of sustainable funds following the ESG criteria, which means environmental, social, and governance. And yeah, this is what we were working on the last 4 years.
Okay, thanks. So, well, let's just dive in, because in many ways, you know, both of you are kind of reinventing the whole approach to banking and investing. As radical as it sounds, I mean, it is actually going back to the roots of banking cooperatives, which, you know, back in the day were created as a way of, you know, helping local communities, connecting with small businesses. Your banker knew your name, your family, your business, and they've grown into these huge entities with opaque products and offerings, and their mission has changed. And as technology solutions have come in, we have a whole generation of new digital banks, N26, Monzo, others, that have made the banking process much more efficient, but not more human. And so I'd like you, Gunnar, to go back. Let's go back a little bit into, what you're trying to achieve with good money. Forbes magazine, wrote a story about you, calling you a hippie. And I can imagine in the U.S., even the term distributed ownership probably sends off like communist alarm bells. How do you sell this idea of, this is something for all of us and an opportunity to really make banking more human, more ethical, and change the game?
Yeah, beautiful. The article she's referring to references that I grew up on a hippie commune, and I think I've been in this strange position where part of my work is to consumerize hippie dreams into a way that keeps the heart and values in, but makes them very mainstream. And so, I think that there's a bunch of ways to answer that question. I think, when I think about the success of conscious enterprise in general, and competing in very, very large markets, because at the end of the day, it is a free market economy, and that's a very powerful, positive thing. The thing that we have found is that we can win in very, very large competitive markets and win very quickly as long as we play to people's self-interest on economic terms, price and convenience, and connect people to a better world. If we can do both of those things at the same time, it's just a better product. We beat and compete with Amazon on price at Thrive Market, but we connect people to a better world. And with good money, being willing to share ownership with the customer for the value that they create as a customer, it means that we can always pay them more than anybody else in the market because everybody else is playing purely on a cash basis. And so this is a very powerful dynamic. At the end of the day, it doesn't matter how well-intentioned we are, we're all wired biologically to be very self-interested as creatures. And so I think that the thing that I'm really fascinated by that's very scalable is the idea that mutually aligned self-interest for good. And that is a very, very powerful organizing principle. I meet, venture capitalists or hardcore capitalists that are very skeptical, and they look at this and they say, oh, this looks like philanthropy. This looks like nonprofit work. And the way I can win those arguments is I say, look, the nominal increase in costs that we absorb to build a positive externality into the architecture of our business is more than offset in arbitrage in the increase in customer quality, the decrease in customer acquisition costs, and the increase of network effects referring customers to us because they feel bought into the purpose.
And both of you are tapping into this larger, I would say growing movement, particularly with millennials, of only really wanting to do business with companies that reflect their values. And I think you're seeing that in the market.
Yeah, we're seeing that. When we started 4 years ago with our sustainable solutions, we're based in Frankfurt, that's the investment capital of Germany. And we told the industry experts that we want to implement a sustainable solution. They just smiled at us and said, nobody will buy that because it's a bit more expensive to go into sustainable funds. And we said, well, we do it nonetheless because we did a survey before, a quite big one, and we talked to millennials and young families. And most of them said, we want to know where our money goes. We want to know whom we are investing in. And we want to make sure that there's what they most of the time said, that there's no military company or something like that in a fund, but that could be. So yeah, and I think the last 4 years, even the big banks saw that coming, that we were right there.
And so right now you're focused on Germany, but you have bigger ambitions, and you think you can tap into this for a larger
I think so too.
audience.
Right now we're just in Germany because it's quite difficult with the regulations in different countries. You need a banking license, and well, we started in Germany, we set that up, but we will see where it goes, yeah.
So one question that immediately came to mind when you described what you're doing about, if the companies that are in your fund are ethical, is there like a real benchmark for that now? Like, how do you tell if it's ethics washing or something real?
No, there's no benchmark right now. I think we need a standard because it's very, very difficult right now. Well, we have a team of experts and we build a catalog of criteria our funds have to fulfill. But as a private person, as an individual, it's quite hard because the whole banking sector is so intransparent to really find something that fits your values. So yeah, I think we all should work together that there's some kind of standard in the future.
And isn't that one of the strong points of your new venture, that people who work with traditional banks have no idea what their money is going into?
Yeah, I mean, you're hitting on the kind of secular consumer trend, which is a desire for transparency, right? And in the face of intense political, economic, and environmental dysfunction, people recognize increasingly that they have real power voting with their money and voting with their purchases. And that's just beginning. Like, we're just in the first inning of that. And it is going to sweep across capitalism because the young people are the ones that are the inheritors of wealth. And it doesn't actually take that much of a decrease in an institutional capital player for them to go into panic mode. And so you can see, where these institutional forces across all segments of consumer capitalism are, in the absence of being able to build these models themselves, they're frantically trying to buy them.
Right. And, it's no accident that the theme in Davos this year is also reimagining capitalism and pushing on this idea that businesses need to be responsible for SDGs and many other things. But it's difficult to imagine how some of these big traditional players can transform. So what is your pitch when you're talking to customers? Like, they are not used to the idea of actually being able to have equity in their bank, and how do you explain to them how does it work and what kind of returns?
The thing is, it's actually very intuitive for people to know that they've been left out of the wealth creation of modern day capitalism. It's very obvious, and all of the media and culture glamorizes those that have made incredible wealth, right? So it's and one of the challenges that we have faced, and we've had to spend millions of dollars on legal just in dealing with how to distribute ownership in a regulatory compliant way, right? So we're actually the first company in history to distribute ownership to customers for the behaviors that they take as customers in a regulatory defensible way.
Wow. And how hard was that to set up?
It was very hard, yeah. I was humbled many times along the way. I mean, the thing is, the SEC structure in the US is meant to protect what's called non-accredited investors, which is, the Main Street, right? These came out of the Great Depression, and there's a lot of efficacy to that. But the very negative byproduct of that is that the public doesn't get access to all of these high-growth deals until the very end, when all the insiders are selling as the public is buying.
Right. So if it's so obvious, why hasn't anyone done this before?
It's the regulatory climate. Yeah. So there's a number of intersections that have made this happen. One, as the internet has become a ubiquitous phenomenon across all market segments. It was, in the early days of the dot-com boom, you could struggle just to get somebody to put their credit card in, right? It was just the jump wasn't there. And so as the internet has kind of driven a ubiquity of understanding and comfort and trust in its own way, that has created a very unique opportunity to transform industries that hadn't been transformed. And so, banking and financial services broadly, arguably the largest markets in the history of our species, are undergoing massive disruption at this point. And in the U.S. alone, there's 150 banks worth $5 to $250 billion. Half of those guys won't make the jump to the digital era. And so the scale of disruption is unprecedented.
But the disruption so far, just to go back to what was said before, the disruption so far has really been about efficiency. You can do banking without going into a branch, or you can more cheaply transfer money across borders. But it isn't about helping and introducing algorithms might make it quicker for some people to get loans, but some of the companies that have done that have actually used that to gouge customers.
Yeah, I mean, even you just think about the concept in the US, you have the concept of a checking and a savings account, which is total bullshit. Like, that's just another way to arbitrage customer deposits. There's no reason why you shouldn't have your yield on a single account.
And anyway, no one gets like interest on their savings now.
I mean,
anyway,
it's like 30 or 40 basis points at best in the US on your savings account. And so a simple improvement that we did is we just have a flex account. So it's a single account. And you earn up to 9% on your deposits the more you purchase on the platform. And for every purchase, you protect 10 trees. And we're able to use the interchange fees that we get from merchants to allocate a small portion of that sustainably in rainforest protection.
Okay. Well, without the benchmarks in place, how do you decide which things are impactful or ethical that your customers should be investing in?
So for me, I mean, I wear kind of the lens of an entrepreneur. So you're always, doesn't matter how well the business is doing, you're always resource constraint in the face of kind of massive competition. And so that in itself is just a forcing function. It forces you to be very, very laser focused on critical path sequencing. And so in that context, I'm always looking for the biggest bang for my buck, which is what are the things that I can invest in that generate the most powerful brand presence, that generate the deepest customer loyalty and network effects that then cause the flywheel and the virtuous cycles to kick in. And that's often just a data play, right? So, you know, when you do direct to consumer, well, you put your product and data teams at the center of the company, just fanatically measure everything so that you eliminate friction in the customer's journey and you optimize the customer's journey.
And so, Nina, for you, what sort of feedback are you getting from your customers about feeling like they're having an impact as individuals?
I think they're quite happy that we combined a solution for two problems, because right now they don't get any interest on their saving account, so they want to solve that because they want to save money for their retirement, for later. And they want to do something good, so they want to be more sustainable. They want to have a sustainable lifestyle right now. So they say, okay, I can combine two things with one product or with one solution, and they're quite happy about that, yeah.
And I think with the work you're doing there, there's this, you know, I think there's a misconception that there's lower returns to be had on that side, which, you know, you look at, you know, Al Gore's generation fund, $20 billion under management, and they outperform the market, right? So there's, you know, even as, you know, these kind of large ESG vehicles that are emerging have all sorts of flaws in their supply chains, they're really significantly and incrementally better than the legacy products.
Yeah, we made the same, we found out the same, because the ESG products are as good or even better than the classical ones. And I think in the future it will be even more, like, because if the bad companies don't get the money anymore and the good do, the good can grow and the bad have to rethink the business models maybe.
I mean, you can see it with BlackRock's announcement last week, right? And, you know, Wall Street Journal article analyzing why they made the decision. And literally in the article, they're talking about how the portfolios of fossil fuel heavy financial products are being penalized by the markets.
Super interesting, and it really reinforces the topic of this conversation, which is you can make money by doing good, right? Yeah. So I think we have time for like maybe one or two quick questions. Do we have any from the audience?
We just silence.
Over here.
You just speak loud.
What's different to a cooperative that you studied, and how do you manage the governance? It's got so many equity and so many shareholders, you need to have a stellar management so you don't get, how do you participate if it goes down?
Yeah, there's a very complicated answer to that question. There are no proven models of distributed ownership at scale that are not subject to hijack. And so both in Thrive and in Good Money, we've been very, very careful, even as we, you know, have done very well as businesses, to protect governance from some of the kind of short-term aspects of transactional capitalism that can come in from institutional capital.
Okay, did we have another question over here?
Well, I'm really curious to know how you're, wow, amplification of your message. How can you, in a more compelling way, communicate to people that they are getting this equity share in the company? I think that's such a brilliant vision to really feel that, you know, you're not only contributing your money for the product that you're getting, but you have a short-term and a long-term benefit. What are your thoughts about how to amplify that more?
Yeah, so again, it's a very kind of, we don't know perfectly because it's never been done before. So it's a combination of storytelling and data. And we think about that in general as content marketing. Content is marketing and marketing is content. And they're actually very much the same thing. And so it's the combination of brand and data in a very kind of rapid sequential way. And so that's a short way of answering what is going to be a very exciting adventure. I think we're out of time,
Yeah,
right?
yes, we're out of time, but please give a nice round of applause for our panel.
Thank you, guys. Yeah.